begin. I'm Al Brooks, and today I'm going to be talking about trading the open, in particular scalping on the open. And I have two websites. The first one is brookstradingcourse.com, and there I have a video course that teaches traders how to trade with price action. And then I have a second website, brookspriceaction.com, and on that site a group of traders run the site, and I'm in a chat room every day talking about the Emini. All right, well, an obvious question is, when does the opening range end? I usually think of the day as having three parts: an opening third, a middle third, and an ending third. And the market usually does something early on in the day, up or down. And then the middle third, it often goes sideways or the opposite way. And then at the end of the day, it decides whether to resume the trend from the open or reverse the trend from the open. The opening range, sometimes there really is no opening range. Sometimes the market on the very first bar forms the low of the day or the high of the day, and then just begins trending. Sometimes the market will go sideways for an hour or two before it begins to have a swing trade. And that's why I say that the range can be sometimes in the first 2 or 3 hours. Now, with the opening range, if the opening range ends with, if the day starts with a trading range, which is the case on a lot of days, to me the opening range ends with the breakout from that trading range, right? So as soon as you get the breakout, the opening range is over, and now you're starting that swing. If the day starts with a breakout, let's say a trend from the first bar or a trend from the first 2 or 3 bars, the opening range, to me, the opening third of the day ends when that breakout begins to convert to a trading range. So it either begins with a breakout and ends with the trading range, or it begins with the trading range and ends with a breakout. I'm sorry, I have a cold. I have these 3 wonderful daughters, and they come home to visit, and they give me these big hugs, and then a week later, this is what I sound like. Now, why trade the opening range? It's because there's a very high probability that if you're careful, you can get a swing trade. And if you're trading the Emini, for me, a swing trade, I have 2 thoughts about swing trades. In general, I think of a swing trade as being a trade where you're planning on making 4 points or more. And then alternatively, a trade where you're going for a reward that is twice your risk. So if you have to, let's say you have a very big bar on the open, or a very, very big series of bars on the open, and your stop has to be 5 points away. For me, a swing would then be 2 times that, 10 points. And the advantage of a swing trade, the math, let me rephrase that. One of the important things about spotting swing trades on the open is that they set up the very best scalps, right? Any trade during the day is a swing trade, because anytime you're going for a reward that's at least twice as big as your risk, the math is okay, right? Scalp, you're usually going for a reward that's only equal to about the size of your risk. And if you think about it, you can only do that if you have a really high probability trade. And what's nice on the open is you very often get a swing trade that is a very high probability swing trade. Now, why do traders trade the open? It's because of this slide. Right? 20% of the days, maybe 1 day a week, the first 5 minutes of the day, the very first bar of the day, is either the low of the day or the high of the day. Also, in the first 35 minutes, I trade California time, so by 7:05, you've seen either the high or low of the day. And in the first 2 hours, 90% of the days, you've seen the high or low of the day. So traders are very aggressive, especially in these first 35 minutes, looking for reversals because they know the math is really good, right? So if you're taking a reversal that looks pretty good in that first 35 minutes or so, you have a really good chance of getting a reward twice your risk. You have a very good chance of getting a 4-point trade. Okay? The goal of most traders, every trader at the start of the day is looking for a swing trade, right? They're the easiest trades to trade, because the market's moving strongly in one direction, and you don't have a lot of management decisions. If the market is going up bar after bar after bar, there's not much thought. There's more just hoping that it keeps going further and further and further. Now, I've traded a long, long time now. I've been trading 27, 28 years now, and I see all kinds of stuff on the chart, all right? It's information overload. And let me go back here. Okay. And a lot of times when I'm waiting for a swing trade, I see all kinds of little setups that are good for scalps, all right? So for me, it's like, a guy's holding out a little bag of money, and it's not much money, but it's money, and I'm asking myself, do I want to take it or not take it? And I'm always going to take it. So I tend to scalp a lot on the open, but my goal is to wait for that swing trade. And a lot of traders do that as well, right? So they want the swing trade, but while they're waiting for it to happen, they'll see little scalps along the way, and they'll take those scalps in the meantime. Okay, how many scalp setups are there on a given day? To be honest, I see scalps on pretty much every bar of the day, right? And when I was young, when I was your age, I used to scalp a lot, 30, 40 trades a day, right? And so I have friends who are scalpers, and that's all they do all day long. I have one friend, talking about trading the open. He only trades the first hour of the day, and he told me that he used to trade all day long, and then he decided that, I'm making all my money in the open, I'm not making money the rest of the day. And he decided to go back over the past month to analyze his trades, and he discovered that he was making 85% of his profit in the first hour, and then 15% of his profit in the remaining 5 or 6 hours. And he decided, heck, I'm only going to trade the open. So he simply started trading the open of the day, and that was it. Some days he'd be there 30 minutes, 40 minutes, other days he'd be there 90 minutes, but pretty much that was it. And he'd say, I'm out of here, bye-bye. You can do that if you're trading enough volume, right? He was trading 100 T-note contracts and 25 Emini contracts, right? So even if you get 2 or 3 points in that first hour, if you trade enough volume, you don't need to trade the rest of the day. Also, his thought was that if he traded the rest of the day, a lot of times he'd get kind of worn out, and he wouldn't be as fresh as he wanted for the first hour of the next day. So he was in there and he was out. I'm sorry, what? 5 minutes. Okay, yeah. I personally trade 5-minute charts. I have friends who trade 3-minute charts. I have other friends who trade charts based on ticks, like 1,000 ticks, 5,000 ticks per bar. I have other friends who trade range charts and all kinds of charts. It doesn't really matter. The price action is the same on all of them, and it really doesn't matter. When I was younger, I did trade 1-minute charts and 2-minute charts, and you can do it, but for me, it was not fun. I felt like I was missing the big picture, and I felt like I was just seeing this little thing. Also, it's really exhausting to do it all day long. And after the first 30 minutes, first hour or so, you start to get a lot of small doji bars. By doji bars, I mean bars with very small bodies, bars without direction. And then it becomes very difficult to read the price action on 1 or 2-minute charts. 1-minute charts especially. 2-minute charts, you can still usually read the price action. So trading has to be fun. I've been doing this a long time, and every day I still look forward to getting up in the morning and trading. And there are things I could do that would allow me to make more money, but I don't do them because they're just not fun. And I love my job, and I make enough money, and I don't want to do things that are going to make me hate my job. I want to be able to do this forever. It's fun. Now, in terms of scalping, right? Most traders should focus on swings and only take occasional scalps, all right? Because it's very difficult to make a living primarily as a scalper. I think it's something you can do if you've been trading a long, long time and you're really comfortable trading, all right? But most traders should focus on swings. In other words, in the E-mini, 4-point trades, or trades where the profit that you're trying to achieve is at least twice your risk. And on most days, there are 2 or 3 4-point swings in the day. And it's rare for a day not to have at least one 4-point swing set up. Okay. Now, my caveat, okay, scalping is hard. It's very difficult to make money scalping, especially if you're trying to do it all day long. And it's far better, especially in that first hour, to focus on swings. If you see some obvious scalps and you're comfortable taking them, go ahead taking them. Go ahead and take them. But I think the best thing you should be doing is looking for a swing. And sometimes that means sitting down doing nothing for an hour or more. And as I said before, the best scalps are also swings. Okay? Main reason to avoid scalps, you have to be thinking quickly and you have to act quickly and you have to exit quickly when you're wrong, all right? And it's also good if you're able to change your mindset in reverse direction. And although it sounds easy, oh yeah, I can get out quickly when I'm wrong, or I can see that I'm wrong, I can change direction. It's really hard to do. You know, I've been trading for a long, long time, and I rarely ever reverse direction on a trade, right? It's easy if you're a computer, but for me, when I'm trading, and let's say I'm long, and I see all the reasons for the long, my first thought is to transition into getting flat, not to transition into the opposite direction. However, if you're scalping on the open, situations happen where the best choice is to reverse. And it's hard to do because you don't have much time. You think, oh, 5-minute chart, 5 minutes, that's a lot of time. It's not a lot of time. You know, when you're looking, you're always feeling like, I just need a little bit more information. Right? I just need a little bit more information. And that's just a basic function of the market, right? Markets don't give you what you want. There are no perfect trades. You know, if you are looking for that little piece of additional information, it's never going to be quite good enough. Because if it's perfect for you, it's perfectly bad for the institution taking the other side of your trade. And that cannot happen. There can never be a trade where it's perfect for you and perfectly bad for the other side. Every trade that takes place requires an institution buying and an institution selling, right? And so the market's going to constantly do something to make it a little bit bad for both and a little bit good for both. Usually, one side has probability. Oh yeah, I'm probably going to make money. But that side usually has bad risk-reward, right? So if you're probably going to make money, the other side is probably going to lose money. So what's in it for them? Risk-reward, right? So they probably have very little risk and a big reward, all right? So you get probability, they get risk-reward. Other times you'll say, you know, I really want to take this trade. I know I'm probably going to lose, but my risk is so small and my reward is so big, I'll take the trade. You know, most swing trades are that way. Most swing trades are risk-reward trades. Probability is low, but the reward is much bigger than the risk. Most scalps are the other side of swing trades, right? Most scalps, you have to risk more than you want. The reward is smaller than you want, but the probability is high that you'll make money. In general, most traders should focus on swings, although it's really, you know, it's really tempting to go for the scalps. Okay. When you're wrong, especially in that first hour and you're scalping, you have to have a plan to get out. And you cannot have stops in your head. I'm sure everyone here at one time or another has had mental stops and the market starts to go against them and they say, oh, I'll let it go a little bit more. And they lower their mental stop. And it goes against them some more and they lower it some more. And then if they lose so much money in that one trade, they need 10 good trades to make up for their loss, right? So, you know, always when you're trading, especially if you're scalping in the first hour, have stops in the market, right? They protect you from yourself. Okay, this is a common situation here as far as the scalp, right? You have a gap up, but that first bar has a fairly prominent tail on top. So that is not a strong trend bar. So you're thinking, tail top, tail bottom, body not too big. It's probably a trading range type open. Trading range buy low, sell high, scalp. So you're looking at that bar and you're saying, that is not, it's breaking out above yesterday's high, but it has a pretty big tail. There's hesitation, there's disappointment for the bulls. If the bulls are disappointed, they won't buy above. In fact, the bears will say, this is bad for the bulls, we'll sell above. So when you see that, a lot of traders will sell with a limit order at the high of that bar, looking for a 1-point scalp, right? and then they see two more small sideways bars, trading range bars. So now you see three trading range bars. Trading range, you want to buy low, sell high. You don't want to buy high. So the odds are, when you see these three bars, what's going to take place above these three bars? The odds are there'll be more sellers than buyers, right? Probably more sellers than buyers. So chances are it's going to go more sideways. Chances are it's going to do something like this or like this, right? But chances are does not mean it absolutely will. So a lot of traders, when they see bars like this, they'll place a limit order to buy that low, buy more 1 point lower, buy more 2 points lower, betting that the bear breakout will fail and the trading range price action will resume. So that it will go down, but it will come back up. Also, they'll place limit orders to sell above bars. They'll sell this high. They'll place a limit order to sell more 1 point higher, a limit order to sell more 1 point higher, right? Betting that whatever bull breakout the market has, it will quickly come back into the trading range, right? Buy low, sell high. It's high. You look to sell. That's more probable than the market going up. However, sometimes you'll see this, right? Chances are there were sellers above. You know, maybe 60% chance there were sellers above. 40% chance the buyers were going to win. This is an example of buyers winning. So if you sell here, you sell more here, you sell more here, right? Maybe you have a 3-point stop in, so your stop is somewhere up here. To me, if I'm doing this sell, I'm going to buy back my short on the close of this bar, because at this point the market is doing something that it should not have done. All right? So I'm clearly wrong and I'm trapped. And in general, if you feel trapped, the market is probably going to go for at least a couple legs in the direction that traps you. All right? So for me, yes, you could be shorting this high, more here, if you're willing to get out on that close. And ideally, if you're willing to get long on that close, right? We have a surprise bar. Surprises usually lead to measured moves, so chances are whatever rally we get following this bar is going to go up for about equal to the height of that bar. It went up a little bit more than that. Point is, right, if you are going to be scalping the open, you have to be able to get out, right? So when you're wrong, you get out, right? And ideally, you have the ability to to reverse. That's going to be unlikely. Alternatively, if you did not take any trades here, thinking, yeah, it's a gap up, it's a bull body, we don't have any big bear bars, maybe it's not such a good short above, and you wait, all right, and then you see this big bull bar, you immediately know that the bears who are shorting here are in big trouble, right? So if you waited for this bar, you buy at the close of that bar, you now have a high probability of making at least a measured move up. Right? So that's a high probability scalp. So if you did not take these shorts and instead waited for the breakout and then bought that close or bought the close of the next bar or bought the close of this bar, right? Here's an example of a high probability scalp, right? So you buy that close, you buy this close, you buy that close, you buy that close, you buy that close, right? You can just keep scalping all the way up, knowing probability is high, but like I said, when you have high probability, you also have big risk and relatively low reward, right? So, if you're buying this close, your stop is below here, so your risk is big, right? And your reward, you might be going for 1 times risk, right? So, let's say it's a 3-point tall bar, 4-point tall bar, you're going for a reward equal to that risk. Another situation that happens fairly often is you get a breakout on the open of a tight trading range, and you say, let's say a bull breakout. Let's say the market races up on the open, right? It goes right up. You think, all I have to do is put my stop below the low of that bar, and I can buy pullbacks as the market's coming down, betting that the market will not fall below the low of that bar, which is true a lot of times, but sometimes if it's still within a tight trading range, you have to be concerned. Let me show you what I mean. This is a fairly common situation. Yesterday ended with a pretty tight trading range. Many reversals, up and down, and up and down, and up and down, right? And then today, the first bar of the day, had a huge bull trend bar, right? We had a bear breakout here, totally reversed here. So now the market's neutral, maybe bullish. We tested down below, so now we have a small expanding triangle, right? And then we have this very strong first bar of the day. We're probably going to trade higher, right? However, there's a problem in this situation, right? You're still in a tight trading range, so where do you put your stop? Do you put it below the low of this? Let's say you buy that close, or let's say you buy above this high, all right? Do you put your stop below this bar? Do you put your stop below this bar, all right? This is a logistical problem for traders. In a situation like this, either I do not buy the close of that bull bar and wait to see if we have one more bar confirming the breakout, all right? Or I get out below this bar because we have an expanding triangle bottom. They usually become expanding triangle bear flags and reverse down, right? So to me, as strong as this bar is and as strong as this bar is, I'm concerned that we may pull back deeply into the triangle, and sometimes triangles get an additional leg down, right? So although this is very bullish and probably buyers below, the problem with it is the buyers may come all the way back down below this triangle. So yes, the market's very bullish here, but you got a problem. Whenever you see a strong breakout on the open and you do not see follow through, you have to be suspicious, right? You got to be really careful. And usually it's better to wait, as bullish as this is, right? It's usually better to wait to see if the second bar is also a strong bull bar and then enter. Because until you have both the breakout, which you have at this point, and follow through buying, you still have a triangle, which is a trading range. And triangles very often have very strong bull trend bars near the top that are followed by reversals down, and very strong bear bars near the bottom that are followed by reversals up. So traders buying, scalping on the open here, they say, yeah, it's probably going to go up. That's true, and it did go up. But because it's still within a trading range, you got to be really quick to decide what to do if you bought that close. To me, I would not buy that close. Had I bought that close, as soon as it turned down, I would be concerned about the expanding triangle. I'd get out there. If I did not get out there, now we have consecutive bear bars, I would get out there. In fact, if I were flat all through here, I would probably sell the high of this bar. We have consecutive bear bars, pretty much completely reversing this bull setup. Probably trapped bulls, probably going to go down one more time. The bulls can argue this is simply a pullback from this breakout, but we have two consecutive big bear bars closing on their lows, very bearish, and then we have a terrible signal bar for the bulls. So to me, it's a sell above the high of this bar. I don't have some tools here, but who would buy up here? All right? If you think about it, who's going to buy up here? Most bulls look at that and say, that's a bad buy setup, okay? But there are bulls who will buy up there, and those bulls are these bulls. The bulls who bought this closed, right? And then they see these two bear bars, they say, darn, I'm in trouble, all right? A lot of these bulls will buy on a stop one tick above here, and now they're long here and here. Their goal is not to make money, okay? The bulls who are buying above this bar, their goal is to get out of their entire position, break even, right? So look where this bar turned down. It turned down right around the midpoint of that initial entry and their second entry one tick above here. So most of the bulls who bought above this bar are bulls who are trying to get out of the second, trying to get out of their entire trade, break even, not with a profit. So the bulls who bought here and again here placed a limit order to get out, break even on the entire trade, the midpoint between their two entries. And so they sold here, and that's what caused this. Bears are aware of this situation, and guess what the bears are doing, right? They know bulls bought here. They knew bulls bought one tick above here. So they figure out where the midpoint is between those two entries, and they'll short one tick below and maybe risk 3 or 4 ticks above, betting that there's going to be a second leg down. Okay. When you're trading on the open, should you be entering with stops or with limit orders? If it's a trading range open, you want to be buying low, selling high, all right? So if you're buying low, you're buying with limit orders below things, below bars. If you think the market is about to break into a strong trend, you want to enter with stop orders, buying above a bar, betting that if it gets above the bar, it's going to trend up. If you think it's going to trend down, you sell below the low of a signal bar, betting on a trend down. So when you think the market is in a trading range, you want to bet that breakouts will fail, so you place limit orders to sell above bars and limit orders to buy below bars. If you think the market is going to trend, you want to bet that breakouts succeed, and you enter with stop orders. First few bars of the day, it often tells you, sometimes the very first bar of the day, it tells you whether or not the day is going to be a trend day or a trading range day. For example, here, the market gapped above yesterday's high and had a huge bear trend day, pretty much like yesterday in the Emini, right? And to me, this is a swing short. When you see a gap above yesterday's high and a big bear bar closing on its low, it's a swing short. You sell one tick below its low. And now we have consecutive bear bars, so we have confirmation by the bears. That increases the probability that the market's going down. So at this point, you sell that close, you place a limit order to sell this high, which is a good trade. Stop above here. Now you have a third consecutive bear bars. The probability is high that we're going to get at least a second leg down, right? So traders will sell that close, place a stop above here, and they'll probably sell more on any bounce. Here, you can say, isn't this simply an opening reversal, testing down to support near the moving average, near yesterday's close? Yes, but you have 3 consecutive bear bars closing on their lows. The odds are very, very high that this is a bad buy setup. If it's a bad buy setup, it's a good sell setup, right? So for scalping on the open here, you sell that close, you sell this close, you sell this close. You see a bad buy setup, so you place a limit order at this high to go short one tick above its high. Stop above here. If you're able to scale in, you place a limit order to sell more 1 or 2 points higher. At this point, you can say we have 2 legs down, 1, 2 to the moving average, and therefore this is a buy. A high 2 buy, an ABC pullback. Well, it is and it's not. When the channel is this tight, right, you cannot be looking to buy, right? The market it's not likely to go from this to this. Usually the best the bears can hope for when you have a buy like this is that the market goes sideways a little bit. So sideways is a trading range. This is a situation in which there probably are sellers above this bar, so it's another short scalp. And you can see it just went pretty much similar to yesterday, an endless pullback. You see bull trend, and this is a pullback and a bull trend, but it doesn't end. It just keeps pulling back and pulling back and pulling back, and at some point you say, it's not a pullback and a bull trend, it's a bear trend. Another example, here's an opening reversal. There's a gap up here, tails top and bottom, second bar, tails top and bottom. To me, that's a limit order open, right? That's the market's looking for direction. There are probably sellers below this bar and buyers below this bar and sellers above this bar. In a situation like this, if traders are going to trade it, they're saying this is a bad stop order market. So most traders would not sell here. If they're going to trade, they're going to buy with a limit order at that low. They get filled here. They place a limit order to buy more 1 or 2 points down, betting that the bear breakout cannot get very far because we have a trading range start to the day. Also, you have to be thinking, we have a gap up. Very often, when you have a bull, if it becomes a bull trend day, most bull trend days sell off early. I don't know if most bull trend days have an initial sell-off early on, and then they trend up. And that's why, if you look at a daily chart, on most of the big bull trend bars, you'll see a little tail on the bottom of the bar. That little tail is an opening reversal. The market sold off and then quickly reversed. If you look at most bear trend bars on the daily chart, they have a little tail on top. And what that means is usually the market tested up early and then reversed, all right? So traders are always looking for opening reversals. Here we have a gap up. We're trying to sell off, but that's a bad entry bar for the bears. A close at that low instead of well below the low, right? So to me, that's not a good swing short. And then you're followed by, following that bar with a pretty strong bull bar, closing on its high. So to me, I'm wondering, is this going to be a bull trend? Is this going to be simply an opening reversal where the market quickly sells off briefly and then reverses up, right? So to me, it's a swing buy for sure above this high, not necessarily a scalp, but at this point, the probability is getting high for the bulls, right? So now we have consecutive bull bars, a close above that high, so we're starting to get signs of strength. We have a potential opening reversal, a gap up, a quick, brief sell-off and reversal up, and now we have a breakout, a close on the high, and a gap, a close above the high of the prior bar, a gap, a close above this high. That's a pretty good sign of strength. So to me, this is a buy the close type market. You can either be swinging all the way up, you can buy above this bar, buy this close, buy that close, buy that close, right? Buy the bear close, right? You can do any of those for a swing, you know. I use a 20 bar exponential moving average on my charts. You don't need a moving average at all right? But there are little tricks that I use with the moving average. And you know, I have friends who use 34 bar, weighted moving averages. I have another friend who uses a 9 and 30 bar simple moving average. I don't think it matters as long as you learn to develop, as long as you start to figure out how the market behaves around whatever moving average you're using. If you're using a moving average, I don't think it matters which one you use. I've just used this one forever, and I'm comfortable with it. But most of the trading that I do has nothing to do with the moving average. So when I see this breakout, I'm buying that close. I'm buying this close. I'm buying this close. I'm buying this bear close. These are all scalps, either 1 or 2 points. The bars are big enough here that it's okay to go for 2-point scalps. But to me, I'm buying 1 tick above here, probably for a swing. I usually try to swing part in a situation like this, but I also scalp. So I'll buy that close, try to get out 2 points, stop below here or stop below here. I buy this close, stop below here or stop below here. I buy this close, same thing, stop below here. I buy the bear close. When it's this strongly up, will the first reversal down work for the bears? No, not at all, right? So chances are a bear reversal will fail. So if the bears are going to sell below that bar, I'm going to buy below that bar because I'm probably going to make money, they're probably going to lose money. So to me, any attempt by the bears to reverse, the first attempt to reverse is a buy. So I'm going to buy that bear close, or I'll place a limit order to buy 1 tick below the low. The bears could not even trigger the short, right? The market did not even fall below the low of that bar. So what does that tell you about the bears? The bears are not very strong. What does it tell you about the bulls? The bulls were extremely eager to buy, right? The bulls wanted to buy below that bar. There were a lot of buy limit orders below the low of that bear bar. Some bulls were so concerned that the market would not fill them below that bar that they simply bought as soon as that bear bar closed. And you can see, as soon as it closed, it traded a tick below and immediately went up, right? That tells you that the market, the bulls are really eager to buy. With that in mind, you can also buy above the high of that bar. Here you can say wedge, 3 pushes up, 1, 2, 3, and it's a short. Well, it could be. It's possible that it's a parabolic wedge opening and reversal. More likely, the best the bears will be able to do is create a trading range. And because of that, bulls will buy below this bar and scale in lower, betting that the best the bears will get is a trading range. And that's what happened here, all right? And then what happened here? A new high, and we sold off. That tells us that we're starting to develop bull scalpers, right? So instead of breaking out above this high and running up, right, we turn down. That tells you that a lot of the bulls think that we're probably going to go sideways. They're scalping. So the bulls who bought down here, instead of holding for a swing up, they took profits at this high, right? And bears will also short at that high. They see all these tails, they see these 2 bear bars, they're betting that we're probably going to go sideways. So they're selling above bars. I'm getting beyond the open. Trading range day, as I said, a lot of times the first few bars of the day give you a lot of information about what the day will be, right? Here we have prominent tails followed by a doji bar, right? Trading range price action. Here we got a big bear breakout, good for the bears, but a fairly prominent tail. Another big bear body, but the tail even bigger. And then we went above that bar and turned down. We went below this bar, turned up. Above this bar and turned down. Below this bar and turned up, right? Instead of traders buying above bars, looking for a swing up, and instead of traders selling below bars with stops, looking for a swing down, they're doing the opposite. The limit order traders are winning, right? So this is telling you that traders are not confident that the market's going to go up very far, so they're selling above bars. They're not confident that it's going to fall very far, so they're buying below bars. They're buying below that bar. They're buying below this bar. They're buying below this bar, right? They bought below this bar, right? So here, early on, we have a lot of trading range price action. So you have to be thinking that this might be a trading range type of day. And when that's the case, traders are looking to buy low, sell high, and scalp, right? They don't know where the low is going to be. They don't know if this is going to be the low or this is going to be the low, right? They don't know where the high is going to be. They don't know if this is going to be the high or if it's going higher. But they do know one thing, that it's probably not going to go very high and it's probably not going to go very low. And because of that, they'll buy below bars and they'll buy near the bottom of the range. So they'll buy above that high, and instead of stopping out, they'll buy more here, or they'll wait for it to reverse up and bet that the breakout to a new low will fail, and they'll buy with a stop above here, right? So traders will buy low, scale in lower, confident that it won't get too far, and they'll even sell high. So in the top half of the range, they'll look for reasons to sell. They'll either sell that bull close, betting there will not be good follow-through. Here's a bull breakout, not very good follow-through. We're near the top of a trading range, possible double top. So a lot of bears will sell that bull close, betting that the next bar will not be a big bull trend bar. Pretty good bet. Or they'll wait and they'll sell below this bar, betting on a double top and a couple legs down. Another day, you have a bear trend, possible lower low major trend reversal, an attempt at a higher low major trend reversal, 2 legs down, 1, 2. Possible ABC correction, high 2, higher low major trend reversal, bear trend, bull breakout, higher low, right? This is an okay swing buy, but then look at your entry bar, okay? It's a doji bar. If you're a bull, you're disappointed. And then the next bar is also a doji bar. So if you're a bull, are you thinking, boy, I made a great buy? Or are you thinking, oh, this is disappointing, right? Whenever you feel disappointed, to me, that's good to know, right? It's radar telling you that it's probably going to be a trading range, right? One of the hallmarks of a trading range is the market does something that looks hopeful, but then immediately disappoints you. So if you're trading and you're disappointed, the market's not doing what you want it to do, you have to be thinking, this is probably not going to be a trend. Whatever rally we get, whatever sell-off we get, will probably simply be legs within trading ranges. So it's really important, I think, to pay attention to disappointment and to confusion, right? Whenever traders are confused, they're not sure where the high and low are, they buy as the market's going down, betting it will not get too far. They'll sell as it's going up, betting that it will not get too far. And so the confusion and disappointment, you always have to be thinking trading range. Okay, so in here, bulls are buying below bars, they're selling above bars, buying below, selling above, okay? If they bought below here, okay, there's a problem here, right? A very strong breakout, a lot of these bulls will say, uh-oh, that shouldn't have happened. We have 3 pushes down, 1, 2, 3. This is a wedge bull flag, and we're getting a bear breakout of a wedge bull flag. This was supposed to be a higher low major trend reversal. It tried to be a higher low here, higher low here, higher low here. 3 times it tried to be a higher low, and instead we're getting a bear breakout. So you have to be aware of the possibility that this is going to form a measuring gap. This high, that low, a gap for some kind of a measured move down. So yes, trading range open, and there were many scalps in here, buying below bars, selling above. But when you see this, you have to be thinking that the character of the day is changing, and we may be swinging down. What do you do with scalping when you have a trading range open? All right. So you see trading range here, flat moving average, lots of prominent tails yesterday, right? Reversals up and down and up, right? Bad follow through, so a lot of trading range price action. For the bulls, they might buy above here, betting on an ABC pullback, 1, 2, 3, a high 2 buy. But when they see this, we have a flat trading range, another doji, right? To me, when I'm trading this, if I'm scalping, I'm saying, well, what's it probably going to do here? It's probably going to do what it did over here and go sideways. So I'm going to place a limit order to buy that low. I get filled here. I place a limit order to buy 1 point lower. I get filled here. And usually, I place a limit order to get out, break even on the first entry. So I try to get out at the same price of my original entry. So I make 0 on my first buy, right? The market went down and I sold out at my original entry price. And I make 1 point on my second buy. And the bears will do the same up here. They'll either sell with a limit order here or sell here. Or if they sell here, they'll try to sell more 1 point higher. And then when it gets back to their original entry price, they buy. And that's why the market stalled here, right? Because you had bears buying, right? The bears who sold are buying back their short. So if the bears are buying, the market's probably not going to fall very fast. But this is, if you really want to do intense scalping, traders trading, looking at this, if you're looking for a swing, you're going to say, this is really not a good environment for a swing trade. I'm going to wait for a really strong breakout up or down before I look for a swing trade. So if I'm not going to be doing a swing trade and I'm going to be doing any kind of a trade, I'm going to be scalping. And if I'm going to be scalping and the market looks like this, there's only one way to do it, and it's with limit orders and scaling in, right? So if you're scalping, it's better not to be buying above bars. It's better only to be selling above bars. It's better not to be selling below bars. It's better only to be buying below bars, right? Okay, so, I talked about a trading range open. Now, what are some signs of the opposite, a strong trend? The single most important sign of a strong trend is consecutive strong trend bars, like 2 or 3 consecutive bull bars, big bodies closing on their highs, or 2, 3, or 4 consecutive big bear bars closing on their lows. Okay. You're looking for a strong breakout from trading range price action. You're looking for a strong reversal. All right. So let's say the market gapped up big, and you have a strong bear reversal bar, like yesterday in the Emini. That could be the start of a strong trend down. Here's an example where the market gapped down and has one bear bar, a fairly prominent tail, so not convincing yet. A second consecutive bear bar, still fairly prominent tail, and the close is still within the range of the first bar. So you're thinking, it's probably a bear trend, but I need more evidence. Once I see this, to me, the market's going down, right? It's going down at least for a measured move based upon the height of what we have so far. So at least from this high to that close, we're going to fall at least for a measured move. You can see there were profit takers around that measured move. So to me, you don't have to trade those first 2 bars. But when you see this third bar, if you did not sell as it's forming, you're selling that close. And now we're in a sell the close type environment. So you sell that close. Another bear close, you sell that close. Another bear close, you sell that close. Another bear close, sell that close. Getting fairly prominent tails, so we may start to pull back, but it's still a sell the close market. And so for me, this is a swing short or a scalp. You can do it either way. You can just keep scalping for 1 or 2 points, just all the way down, or you can be swinging. If you swing a short, selling here or here, I'd put my stop above the top of the bear breakout here or the top of the bear leg, and you just hold on. And, right, because a lot of times it won't get filled. A lot of times. It depends. If I think the market's flowing in a free fall, I'll just hit the market, okay? Or I'll place a limit order 2 ticks below the close, right, to make sure that I'm going to get in. And that's important to recognize, because if you're that eager to get in, everybody's that eager to get in, and it's going to go quickly. All right. Right, yeah, you're right, because, you know, if you try to be too cute and say, I'm going to try to get the exact best tick, I'm going to place a limit order, as soon as the bar closes, I'm going to place a limit order to sell the close of that bar. If the trend is really strong, a lot of times you won't get filled. You know, for example, here, look at this bear bar, right? Big tail, so you think, oh, I can just place, there's some buying pressure here. If I place a limit order as soon as that bar closes, to sell at the close of that bar, you know, I can't really see from this angle, but a lot of times, if you try to do that, it never goes above that close, and you never get filled, and you miss the next leg down. Okay. Here's an example of a strong bull bar, and the context is good for the bulls. We have a trading range, and we have a bear breakout, so chances are it's going to fail. And then we have a pretty good looking bull bar closing near its high. So that's a pretty good trade. Chances are we're going to go at least up to yesterday's close, right? So you can either buy above that bar for a swing up or for a scalp. The probability is high, so you can do it for a scalp. Now you have a second consecutive bull bar. You can buy that close for a scalp, right? Or for a swing. Third, same thing, here, right? So these are all buy scalps or swing trades. It depends on the situation. Depends on the situation. If I feel like it's, I tend to lean toward lots of trades, right? So I tend to scale in and scale out, right? Okay. But I think it's perfectly fine. I have another friend who, actually I have a lot of friends who they just hold and until the market starts to reverse, and then they start to take profits, all right? Or they either take all or part off. All right. If a trend is really strong, you can make a lot of points, you know, just sitting there. You know, I have another friend who every day he would trade. He'd wait for the swing in the morning, and then he'd take the swing trade, and he'd say, "Al, I'm going to go shopping," and you know he'd place a stop in the market, and then he'd place a limit order far away, like 10 points away, and he'd come back in 2 or 3 hours. And you say, oh, Al, look, I made 10 points today, and that's okay. You can make a lot of points. You know, if you see a swing setup, and you find that you're always scalping out 1 point on a trade that goes 10 or 15 points, right? It's a very good strategy to enter, put your stop in, and come back in an hour or two, and then think about getting out instead of thinking about getting out in the next bar or two. I'm sorry, what? Always in? Yeah. See, I use the phrase always in long, always in short, right? What I think is, if I had to be in the market at this moment, if I just put up any chart and I have to be in the market at this moment, right, would I be long or short? And usually you can look at the chart and say, yeah, if I had to be in this market right now, I'd be long or I'd be short, right? Sometimes it's really obvious. You know, you look at the market and it's in a free fall, I'm never going to be thinking about buying. I'm only thinking about selling. So if I had to do anything, I'd sell. Usually, if the market's in a strong trend like that, and it's in a free fall or in a very strong rally, and I'm looking at it and thinking, let's say it's a strong rally, and I'm looking at it and thinking, gosh, I really think I should be long. You know what I do? I buy. I buy at the market, right? If I think that I really wish I want to be long, and I really hope that we get a pullback soon, right? That's whenever I'm hoping for a pullback, I have to enter right there, right? Because whenever I'm hoping for a pullback, everybody's hoping for a pullback, and that means everyone's buying 1 or 2 tick pullbacks. They're not waiting for the market to pull back 3 or 4 or 5 bars. You know, they're buying 1 or 2 ticks down, right? So anytime I'm hoping for a pullback, I get in right away. What? Wide stops? Yes, I use wide stops. So I'll show you an example. It's like the ones I was saying, that if you have a strong bull breakout, the stop is way below the bottom of the breakout. If you have a big bear breakout, the stop is way above the top of the bear breakout. So if you're entering at the market and your stop is far away, you have to trade very small. However, trading very small can still result in a surprisingly big profit if the market just keeps going and going and going. Okay, consecutive trend bars, you know, 2 consecutive strong trend bars, a bull bar and another bull bar, a big bear bar, another big bear bar. Usually you're going to get a trend. But if the context is bad, you will not. So here's an example. Okay, you have a very good looking bull bar, and you have a second very good looking bull bar. So you say, that's a pretty strong open, probably buyers below. Except for one thing, a couple things. First of all, the channel down yesterday was very tight with very little selling pressure. There were not strong reversals in this channel, all right? So you have to be thinking that the first leg up for the bulls probably will not get very far, and the best the bulls can hope for is a trading range. And in fact, a strong bull trend bar near the moving average when the market has not been to the moving average in 20 bars, 30 bars, the bears are going to sell that bar strongly, right? So to me, yes, we have consecutive bull trend bars, which is normally a buy, and it normally means there are buyers below. But when you have a small pullback bear trend with no buying pressure, you know, I'm not going to be buying this close. I'm going to wait. I might consider selling. In this situation, I probably would wait. Once I see this, 3 consecutive bear bars, I think, and then a weak buy signal, I'm going to be selling above that high. If I'm going to take any trade, I'm going to sell above this high, betting that it's a bad bottom. So just because you have consecutive bull trend bars, if the context is bad, it's not a buy. Okay? Market is always looking for direction. So it's constantly probing up and down. It needs to find out what is too far, all right? And most days, the first direction is wrong. And the initial move usually creates an opening reversal. Okay, an opening reversal, for me, it's a strong, quick test of support or resistance, right? So if the market quickly races up 2 or 3 bars to a resistance level and then reverses down, that's an opening reversal down. And if it on the open quickly falls to a support level and reverses up, that's an opening reversal up. And those reversals create tails. Okay. Here, we opened below yesterday's trading range and reversed up, so it's an opening reversal, possible bull trend day. Here, I don't really have time to talk about it, but we went above the trading range, and this is a parabolic wedge. 3 pushes up, first push here, second push here, third push here, third push subdivided. We reversed down. So is it an opening reversal, top and bottom? You know, you could call it that. I'm always looking for swing trades on the open, and you know, an obvious one is a major trend reversal, and then also a breakout or a failed breakout of anything. You know, a breakout above a trend line, below a trend line, a trading range, a moving average, especially yesterday's high and yesterday's low. Right? I'm always looking to see what the market does at these key support and resistance levels. Will it break out? If it does, will it break out strongly and therefore probably have a trend? Or will the breakout have problems with it and therefore will it likely reverse and have a trend in the opposite direction? Okay. Is the trend continuing or is it failing? Right? If it's failing, let's say you have a bull breakout and then it starts to reverse. Is that reversal the start of a bear trend, or is that reversal the start of a pullback? And will there be buyers there looking to buy it? You know, those are other decisions that I have to make. You know, on my charts, I usually have a 60-minute 20-bar moving average plotted on the 5-minute chart. So I can see basically what the 60-minute chart is doing. However, why do you choose 60? Because to me it looks like a lot of the computers are trading 60-minute charts. All right. If you look at what's going on the 60-minute chart, it's so perfect. The behavior is so perfect that it's got to be owned by computers. Same with the 5-minute chart. You know, so much of it is so perfect that it can only be that way if a whole bunch of computers are seeing the same thing and doing the same thing at the same time. You know, 30 minutes fine too. You know, I have another friend who trades 8 and 13-minute charts. I have another friend who trades a 4-minute chart. All right. I have other traders. As I said, another friend of mine just trades range charts. It doesn't matter because they're just simply a representation of the market forces underneath, and they're all going to be telling you the same thing. Okay. Swings usually begin with a strong signal bar. All right. So a bull swing usually begins with a bar with a strong bull body, with a close at or near its high. A bear swing usually begins with a bear body, a close at or near its low. So here, let me go back there. Here we have a very strong bull bar. It's possibly a pullback from this breakout. So this is a potential swing buy. So it's a buy either above that high or on the second bar or even on that third bar. Here's that, I mentioned that I often have a 60-minute, 20-bar exponential moving average plotted on the 5-minute chart. And here you can see the 60-minute chart is sideways, right? The moving average is sideways. Strong sell signal bar. Bear trends usually begin with strong sell signal bars. We have a strong bull bar stalling at the 60-minute moving average and reversing down. So for me, this is an opening reversal at the 60-minute, 20-bar exponential moving average. So to me, it's a short below the low of that bar. Stop above the high of that bar. So you see this and you say, well, Al, isn't it also a 5-minute opening reversal? Isn't it simply a pullback to the 5-minute moving average and an opening reversal up? It can be, right? And I could be wrong. But if I were trading this, I would short 1 tick below that bear bar, looking at it as a 60-minute opening reversal. And if I did not take that short, I'd look at this 5-minute opening reversal and I'd say, that small doji bar is a terrible looking buy signal bar, and therefore it's probably a bad buy, and therefore they're probably sellers above. So had I not...
Excuse me, I'm going to interrupt you. If that little doji to the right, if it comes above that 60 average, moving average together, you probably take it along.
If that bar became an outside up bar and closed way up here, okay, I would be buying. Okay. Yeah, but otherwise, I'm either selling below that bar or selling above this bar and holding for a swing. Here we got a wedge bottom, 3 pushes down. This bear bar and then bull bars. Bear bar, well actually, you got a tail here. First push down here, second push down here, third push down here. Possibly a wedge bull flag, higher low major trend reversal. Bear trend, bull breakout, a wedge bull flag, 3 pushes down, 1, 2, 3. And we have a 2-bar reversal, but it never triggered. So instead of going above the top of the buy signal bar, the market fell below the bottom. All right, so you have a failed wedge bull flag, and you quickly fell for a measured move down. So in a situation like this, arguably it's a buy above the high of that bull bar, but you have to be thinking it's a bull flag. It could have a bear breakout as well. If it falls below, it could quickly fall for a measured move down. Okay, I'm sorry, what? Oh, they're 20 bar. On my website, you can. I have the TradeStation formula on how to create the 60-minute moving average and put it on the 5-minute chart. She just came in and warned me. She said, "Get out in 5 minutes." She just held up a sign. So I got to speed up here. One other point I want to make is if there is no clear signal bar, and this is common, whenever you're looking to buy or you're looking to sell, but the signal bar is just not good enough, don't take it. You know, for example, yesterday, the market was selling off all day. I was in my trading room for the first 2 hours, and I was saying, yeah, we're getting bull reversal bars, but they're probably sellers above. The channel down is too tight. So if ever the signal bar is really not all that clear, don't enter. Wait until there's a strong breakout. So whenever I'm trading, I'm either looking for a good signal bar with good context or a strong breakout. And I don't want to get tempted into buying a bad signal bar. I'd rather enter late after I see a strong breakout. So for example here, all right, Not a very good-looking buy signal bar. You got a big bear body, right? Context is good, right? So to me, I would probably wait to buy either that close or this close. At this point, you look at that and you say, what's the market going to do? Is it going to go up or down? Right? What's it probably going to do? It's probably going to go up, right? So I have to get long. So I'm buying that close. I'm putting a stop either below here or all the way down here, and pretty confident that we'll get at least a couple legs up from that strong reversal. I'm going to quickly go through some slides because I'm out of time. Common situation here, a gap up, a sell-off, 3 pushes down, 1, 2, 3, a possible wedge bull flag at the moving average. I'm looking for a swing buy. Other common situations, another wedge bull flag, push down here, 2, 3, near the moving average. Here's 4 pushes down. I'm looking for an opening reversal up. Here, break up below yesterday's low, a first entry. We tried to sell off again, and we're trying to reverse up again a second time around yesterday's low. So I'm looking to buy. Either I'd buy here or I'd wait for the reversal up. Not very strongly up. Bull bar, bad follow through, couple bull bars. To me, this looks like a bull leg in what will become a trading range. Double bottoms are common. You have a gap up and a double bottom. I'm looking for that, to buy that. Another version of a double bottom. To me, that's a reasonable buy. But then the rally up is weak. Every bull bar is followed by a bear bar. Every bull breakout followed by a bear bar. This is probably going to turn out to be a bull leg in a trading range. So you got to be thinking that maybe it's going to be a wedge bear flag and the start of a trend down. Strong major trend reversal, bear trend, strong breakout, pullback, good looking bull bar, tried to reverse down again below yesterday's low and reversed up. So a micro double bottom, down here, up, down here, again, reversed up. So I'm either buying here or by this point it's clearly very strongly up. At this point you can buy for any reason. Buy bull closes, buy above bars, buy below bars. Use a stop either below here, or all the way down there. I'm going to stop here for questions because the next speaker has to come in. Yes?